Right, very good morning, everyone. My name is Howie, and welcome to our webinar, Investing in a Time of COVID-19. Right, this morning's webinar is brought to you by the Edge Singapore and also Edge Prop Singapore, and proudly sponsored by CapitaLand. Right, the Edge Singapore, we deliver timely and insightful news so you can make your investment decisions, and also Edge Prop Singapore, we are a property portal, and you can also have your analytics over there. Right, before we go into it, let's look at our sponsors video. This morning, we have 5 guests join us for our webinar, Investing in a Time of COVID-19. And we're very thankful for them. And they are none other than Mr. Seng Wun. He is the Economist Director at CIMB Private Banking. Mr. Geoff Howie is the Market Strategist at SGX. Mr. Terence Wong is CEO of Azure Capital. Ms. Alice Tan is Senior Director, Research and Consulting at Edmund and Company. And Dr. Boaz Boon is Director of Trinity House Investments. At the end of this session today, we will have a panel discussion where we'll answer all your questions, and that's moderated by Dr. Boaz. So if you have any questions, there's a Zoom panel at the bottom of your screen. It says Q&A. So post your questions there. I can already see 7 questions, but I'm sure at the end of the session, there's going to be a lot more. Right. And so without further ado, I think we'll jump right into our first speaker, and his topic will be the moment of truth for the global economy, the outlook. Mr. Song, please.
Okay, good morning, everybody. It's time to, I suppose, wake up if you're still in bed. Nice and shiny weather out there. Right, I suppose I'm just a seat warmer. You got a panel of very great speakers coming up. We are the thorn among the rose. We got Alice towards the end, give a view of the property sector and implication. Actually, my segment can be done quite quickly. Things are bad, likely to stay bad, and hopefully get better done, and then we basically can get through. But we have a few slides to go through. I suppose just a quick recap. Right, this would be my 4th recession. I started working in '85. That was my first recession. That was second oil shock. I mean, if we look back at the Singapore history, not that long, over 50 years, we have a recession, D1 every decade or so. This latest one, after 2009 global financial crisis, has been actually quite extended. So central banks, government, actually had been looking around to see what possibly could trigger the next downturn. Over the last couple of years, things like SARS were penciled in as a tail risk pandemic, but more recent years, and obviously the last year or two, it had been trade war, geopolitics, and as highlighted as a risk towards the global economy. And black swan event, we really don't know what kind could turn up. In the end, it turned out to be this little virus that triggered a global lockdown. So what we have after essentially more than a decade of very strong growth, slowing already before the pandemic, we are now essentially seeing the fallout of the lockdown, plus obviously the recession that follows, and implication of how we get on our feet, and then to what kind of shape of the recovery will look like. Many talk about the only V. I think the only V you will probably see is things like the PMI reading, where it was really terrible in the case of China, early part of February, and things less bad now, or in European countries and other developed economies, things were terrible. over March and April, but the May reading should recover. So that's only about the only V you'll see, that things are less bad going forward, but we are still going to be recovering from a very depressed level, well below where we have fallen from. Okay, I will share a couple of slides here to take us through in terms of what are some of the numbers that we are possibly talking about. At this point, all these numbers have a very, very wide sort of a range of error around that true path, which is why we have seen Singapore government, after it rolled out its annual budget back in February, followed through effectively a budget a month as we try to contain the damage to the economy as the pandemic and the lockdown recession take hold elsewhere. Right, let's see how we're going to do this. Here we go. Stop sharing screen. Okay, here we go. Share. Can you see the screen? Thumbs up, people. Okay, here we go.
Yep,
Big macro picture, pretty fast in terms of where we're seeing going forward. Here, I suppose, again, is what I was talking about earlier. The only V-shape that you probably see, the PMI reading, which plunged to unprecedented level. You've been hearing unprecedented, many times, and I think you're sick of it already, since the I suppose, end of or beginning of February. And we are seeing this kind of numbers is effectively. Where we are seeing, so a lockdown recession, as mentioned, obviously first by the IMF itself. And this set of forecasts really began and has been revised, but this is the first set as far as the IMF are concerned back in the early April when they announced their update to their 2020 global forecast. And what it matters to Singapore, a very small open economy, is that line on global trade of volume. And we can clearly see that even then, the forecast was volume likely to shrink. And obviously, as lockdown are still in place in many countries, are only just being eased right now. There are still going to be obstacles to trade. For instance, you and I working from home or just staying at home most of the time, you'll probably find that you're just spending less, except from the trip to the supermarket, your online occasional shopping, and your tapao. That's basically all that you have spent on. So you got some savings. Only said bad news is that the interest rate is pretty depressed and probably will continue to stay pretty low. If you are a saver, if you are a borrower, it's great news for you. But bad news for Singapore, when we are so dependent on trade in goods and services. Remember, trade in goods and services 3 times the size of our GDP. So it will have a massive impact on Singapore. And us in Singapore, government can only do so much for a small city-state, very small population. We're talking about 5.7 million for an economy that generates GDP worth, I'm just rounding it down, 500 billion. So if you roughly, again, simply make it very simple, it works out to be about 1.4, 1.5 billion a day in terms of GDP. So if you are seeing a big hit to the economy as a result of the lockdown, you can guess 30% down, 50% down. So take it halfway, 50%. You're talking about a hit to Singapore in the GDP per day of anything from 400 to 700 million. What kind of spending can the government roll out to create that kind of value add? Impossible. So even the private sector, so even the government step up spending, private spending has collapsed so much that government spending in terms of what have been rolled out on the budget so far still would be unable to turn Singapore around. We are still in a recession. We're still heading into a deeper recession. It's just cushioning the impact as we go along. So that contraction in the volume of trade has very significant implication for the Singapore economy. Here I've got another news from Clarkson. This is basically they just essentially make a projection of global container. So they're also in terms of similar, in terms of global trade volume, they essentially say container liner this year, record plunge, down 10% at the minimum. So all these things, obviously, when I come back to Singapore, what it means is just outside my window is Tanjong Pagar ports. Volume of trade has slowed down. Changi airports, activities fairly minimal, as we can see. Now, it would have been fine and well if we go forward against the backdrop of where governments everywhere can easily spend and lift obviously the economy going forward. But because we entered this recession at a very obviously matured late stage, prolonged actually, on very, very low interest rate. Interest rate is low and likely to stay low unless we see a huge spike in inflation and interest rate goes up, and that could compound the crisis. The record level of debt, which already occurred towards the tail end of the last year, for instance. Remember, up to 2 years ago, governments were already warning about leveraging because of low interest rate. Remember, 2 years ago, I remember my birthday is July the 5th, when the government announced more measures to tighten so borrowing within the Singapore property sector. There were a lot of hue and cry at that time that government is taking away the punch bowl. On hindsight, it's timely. Remember, we have seen banks asking you to return credit cards. We saw credit cards, number of credit cards in Singapore shrunk over the last few years. So government, not just in Singapore, regulators everywhere were already warning of the record level of debt, which obviously will be a risk if we were to go into a recession. But obviously, the record level of debt has grown even higher because government everywhere, central bank everywhere, not just printing money, government are also piling on debt as they try to lift the economy. Singapore, obviously, lucky in terms of we have the reserve to fall back on, but we have a very deep pocket in terms of keeping the economy going without resorting to borrowing. In fact, Singapore should borrow. I mean, we're the only nation in Asia with AAA rating, rated by S&P, the credit rating agency. I think only 10 in the world with AAA rating as well. So in fact, we can go out and borrow very, very cheap. But obviously, it still comes with a cost. So using our reserve, I suppose for now, does make sense. But where it can hamper the recovery going forward is that this level of debt, especially in emerging developing economy, can be a big constraint on growth. Not everybody is the USA. USA can print debt, incur enormous debt, and because their currency is a trade of the world, they are the superpower of the world, doesn't matter, which is quite strange, but that's the advantage of being the number one. So when you are the largest and you owe people the most, people are worried that if in case you fail, they'll pull everything down as well. So that's something to think about. Now, obviously, in terms of what we're seeing now is that recession is unfolding, but lights are being turned on around the world. So as we're seeing this weekend, I just came back from a little walk, and just by seeing the activities on the road, there's a lot more vehicle on the road. People are going back to the office, turn on the light, do a little bit of dusting, get ready for when the circuit breaker, in a sense, some of the measures are eased. But then again, this is just turning on the lights. Many people are still staying at home. But when you were in a position where rooms were darkened across the island and now being turned on, this is the first step towards that recovery. And this is where the hopes of a recovery has been, I suppose, be most obvious, in that from pitch darkness, now you're seeing lights, now you're seeing green shoots of recovery, but obviously recovery from a very, very depressed level. And government everywhere are still taking a whatever it takes approach, which is why government are still, this week, it's not just Singapore announcing, a fourth supplementary budget in that sense. We got Japan talking about more. We got the European government, also European Commission, talking about more need to be done to help businesses. And we are still seeing interest rate being cut. Last week, I think it was the Bank of Korea. Although I think we are towards the tail end of rate cuts already. For many, they're already zero. For some, they're already negative. We don't see US going to negative, but we can never say never, especially since the impact of the recession, I think, is still rolling through the economy. But for now, markets are looking beyond the I suppose, the dark period in terms of looking towards that first sign of lights. And that has, I think, supported market sentiment. But obviously, we're not talking about Donald Trump behind and the US administration, who is still creating, I think, a lot of worry when it is using the US administration using other issues, China especially, Hong Kong, Taiwan, Huawei and technology as an end, as a means to an end, i.e. I think US dominance in areas to continue. Okay, towards the last few slides, this is roughly our sort of take of the region of the global economy and where we were earlier in terms of the, obviously the numbers is we are going to see the region here, or the ASEAN region, I think experiencing fairly deep contraction in the second quarter. That's a given. Every country. In Singapore, Q1 was less bad, which is good because a few factories, pharmaceutical factories in Tuas Avenue South, if you want to know precisely where the heavy lifting to the Singapore economy came from, was Tuas Avenue South. The factories there, the Pfizer, your GSK, they were certainly producing a lot more. And where we have at this point, okay, are we still moving on the slides?
Yes.
Okay.
So we got the slides running. Let us know.
Yeah, keep going to the CIMB macro slides. Keep going. And yes, next one, please. Right. So here we are in terms of our ASEAN 5 macro forecast. As I say, this is just essentially, we don't know where the true path will be. But I think for Singapore, when we look at that line on Singapore, we were essentially, I think the only thing which can save us is what we saw in Q1, where the pharmaceutical facilities in Tuas Avenue South did really well. I mean, we saw record output from them in April and May. And if it continues, our 18% contraction in Q2 year on year, which is about as bad as you can ever see in my life, and probably in many other life as well, be less bad. But if we are still talking about perhaps even contribution from pharmaceutical come in around 10% down. So that's still going to be the worst case ever. If you look down, the whole region is just contraction. Not a surprise when businesses are being interrupted, supply shock, you can't do anything, you can't deliver anything, you can't move anything, and domestically consumption have collapsed. Going forward, as easing measures are essentially, I suppose, put in place, or easing measures take place, hopefully the lights get brighter and the contraction obviously will narrow. But we are still talking about, well below pre-crisis. Remember the beauty of stats and how we can lie with stats is if you start with 100 and you fall 50, you are at 50. If you recover 50, you are back at 75. You're still below pre-crisis level. And that essentially might look good from a V shape, but businesses at the margin who are already struggling before the pandemic, which is why you probably have seen many of you, a list of F&B join who have since closed. Many of them are already struggling towards the tail end of last year because the economy was already slowing. And obviously with circuit breaker measures in place, many around them in my neighborhood in Tanjong Pagar have already shuttered as well. The interesting bit is going to see how the rentals for many of these shop lots will pan out. And where it's very interesting is that for many of the landlords, they have deep pockets. So it's going to be a case of whether the recession is going to impact the landlord as much as what it used to be, or whether landlord will be also more accommodative and see rentals come down. But this is kind of numbers that we're seeing. The only thing which is, I suppose, which we handle well after our 1998 financial crisis is currencies are essentially fundamentally driven, market driven, and which is why we don't really have that much of a pressure on the exchange rate, although we did see significant pressure on the Indonesian currencies itself because they are worried about capital outflow. But even so, I think they have done well to be able to still stabilize it around that 16,000 to US dollars. And so the impact this time around on the economy is less severe in that sense from the currency crisis of 1998. Okay, next one, please. So where do we have? Howie, keep going. Okay, so where we are at this point, well, it's the new normal. Obviously, we don't know what kind of shape. As I say, we can rule out V shape. The only V you see maybe my neckline, or perhaps the PMI numbers. Reality is probably a kind of a hockey stick, best case, worst case, L shape. But that doesn't mean that there's no opportunity at this juncture out there. Even in recessionary conditions, the difference this time is technology has made a huge difference this time. Just imagine if we were in the 98 financial crisis, we don't have the kind of technology that we have, the impact on the economy, but obviously very different as well, because the economy, global economy, wasn't as integrated then in 1998 without the technology. Now we have technology. The bad thing about us being integrated, obviously, is the impact felt immediately and amplified. The good thing being integrated is technology allows you not just to tap on the neighborhood of, say, Tanjong Pagar or Ang Mo Kio, but the region, the economy. You know, some makcik that at some store I was talking to said, wow, I don't know about this digitization, how to sell my nasi lemak. Say, makcik, you got Facebook, you got WhatsApp. That's the first step already. The only thing you need to do is how to make a nasi lemak look a bit more sexy, and then you can sell them and compete against the uncle next door who still don't know about Facebook and WhatsApp. So that's the kind of what of technology creating the kind of opportunity that we see, I think, this juncture, the rise of technology, digitalization, how I think perhaps even blockchain can be embraced to help within the whole supply chain. And this is where obviously the businesses are being helped, and new businesses and activities are being created.
Mr. Song, I'm gonna have to interrupt you for a bit. Can we go on for the next minute?
Yeah, done.
Yep. This is all. Maybe you can wrap it up.
So basically, that is essentially the opportunity that we have at this juncture of growth coming through, but obviously risk as the recession will be hitting economy at the margins, and yet at the same time we got opportunities as well. So importantly, and why we have to keep our labor market in as good as condition as it is today really is about ensuring that the recovery is on more stable ground, and we have greater clarity on the spending as well. If not, I think it will have a far more severe impact on our growth and regional as well. Pass it back to you. Thank you.
Thank you very much. Thank you very much, Mr. Song. Very pessimistic start to the day. So I see a few questions about whether there'll be videos shared after this and whether the slides will be shared. So at the end of the session, there will be a survey where we will then send to you some of the slides after that, and also we'll share the video on our website after today's session. Right. So can I also remind the speakers to turn your slides to presentation mode? And next up, we have Mr. Geoff Howie, who is the market strategist at SGX. He's going to talk to us about protecting yourself and your portfolio against COVID-19. Mr. Geoff, please. You're still muted.
The host is unmuting me and I'm unmuting myself.
Right.
Okay. Everything keeps minimizing. So I'm very sorry. I'm about to share my screen and we're about to start. So just bear with me. Share the screen. Yes, I do want to interrupt. Thank you. Thank you for your patience. And thank you so much to the Edge and the Edge Prop Singapore for the invitation to speak today. Team, am I all okay? Everything's up?
Yeah, everything's running.
Great. So the topic today is, for my 20 minutes or so, is to talk about, I guess, protecting portfolios against times of increased volatility, more economic uncertainty, which we've definitely seen over the last 5 months, the first 5 months of 2020. I think, just to bridge on to what Song was saying, back in mid-May, Fed Reserve Chair Jerome Powell, he did make a diagnosis, which was a global diagnosis. He said on a 60 Minutes TV program that if the US GDP is to move back up from what they're expecting to be very, very low numbers this quarter, and if unemployment is to come back down, the big thing that the US has to do is to avoid a second wave of the virus over the next couple of months. And that, of course, goes for all of us across the world. So to that end, we all do have a role to play in staying safe. For my presentation, I will point out that this is going to be a purely educative overview of events in our local market. We're going to look at portfolio application examples. So to that end, the presentation will be advisory, will not be advisory and won't be forward-looking. As you probably well know, Singapore Exchange, it does offer a very highly diversified stock market with its largest capitalized stocks representing 3 of the world's strongest banks, some of the world's biggest real estate organizations, one of which is a sponsor for today. We've got a multitude of significantly different businesses that span all different sectors with significant connections to Asia Pacific. And a number of security products also exist on our exchange for sophisticated investors. And that includes those who look to hedge portfolios with structured warrants or daily leverage certificates. But with the limited, 18 minutes we've got left for this session, we're just going to quickly cover 3 of the most popular methods that investors seek to use to hedge portfolios. And the first, of course, is the gold ETF. The second being stocks with a history of defensive performances, and the third being index futures. So slide 4, this next slide, over the next 20, so let's just take a step back and look back over the last 5 months. So for the first 21 weeks of 2020, we saw our Straits Times Index benchmark decline some 20%. The STI declined as much as 30%, down to 2208 back in the 23rd of March, and then did rebound somewhat. So it's rebounded somewhat from, you can see this blue line here. It's representing gold, but the green line is representing the Straits Times Index. So we're down around 20% in the year to date, but you can see down to this point here, we were down as much as 30% before we've seen a 15% rebound through to the 21st of May, or a 14% rebound through to yesterday's close. But what we've also seen is, you can see this dark blue line. This is our gold ETF. As we can see, it's moved inversely to the STI. In Singapore dollar terms, effectively over this 20-week period, this blue line gained 20%, while this green line declined 20%. So gold's outpacing of the STI was in 2020. It did not start in 2020. As Song was saying, we were having quite a few issues in 2019 in terms of trade tensions, and particularly in the manufacturing sector. Those PMI numbers hadn't just come down this year. They'd been gradually declining before we did see some, tentative recovery towards the end of the year. But we basically saw in the year of 2019 as well, gold outpaced the STI for much of that year. If you look at during 2019, the STI did generate a respectable 9% total return, but the STI did outpace the STI. The gold ETF did outpace the STI with a 17% gain. So what am I talking about? I guess just to take a moment just to either introduce to you or to reintroduce to you the Spider Gold ETF. I guess if I had a minute and there were 3 key points I wanted to use to sell this ETF to you, or to effectively provide a good overview, there's 3 points. The first is the whole objective of this particular ETF is to reflect the performance of the price of gold bullion. So it's basically tracking the price of gold bullion. There is a fund expense, a trust expense, which is 0.4% or 0.4% per annum. And what the units or the shares in this ETF represent are fractional, undivided interests in the trust. And the primary asset of the trust is, of course, allocated gold. And you own the units or the trust, units in the trust, the shares in the trust. The ETF is also based on the LBMA gold price as a reference mark, and that is used to calculate the net asset value of the trust. The second key point about this ETF is it is a global asset class. This actual ETF is not just traded here in Singapore, it's also traded on 4 other exchanges, which does showcase the global interest in this ETF. Since its inception in when was it, November 2004, the ETF has generalized an annualized return of 9% per annum in US dollar terms, or if you look in Singapore dollar terms, that annualized return since November 2004 through to May 2020 was 8% a year. It was subsequently listed, this ETF, which is traded across the world, in October 2006 on SGX. And the intention was to offer a vehicle to investors that would lower barriers of entry into the gold market, such as issues with access or custody or transaction costs, which has traditionally prevented investors from investing in gold. Even recently, I recall an article by Adam Aziz in the Edge Malaysia, in the Edge markets in KL, noting that investors in Malaysia were looking to acquire gold. They might have been experiencing difficulty with such a demand surge in gold, which was coupled by some supply chain halts in the global lockdown. So that it's very real, this access and this efficiency edge that the gold ETF offers. And also, I might also note, back in 2011, briefly, for a brief period of time, this particular ETF, with its 4 other listings across the world, was briefly ranked the world's biggest ETF by assets under management. But that's the second point. The third and final point on this gold ETF is, as I have included in this first bullet point here, where we say portfolio diversification, including assets with a low correlation to each other, it obviously does help to reduce portfolio risk. And traditionally, the STI, Straits Times Index, does have a pretty low correlation to gold. Looking back over the last 5 or 10 years, the correlation of the STI price to the gold price is around 5%. And that compares to around 70% correlation that the STI has with crude oil. So it's a very low correlation to gold. And of course, the World Gold Council do suggest that when investors do have risky assets in their portfolio, gold should make up some 2% to 10% of the portfolio, obviously pending on what the customer wants. But to sum up, I guess what this gold ETF can offer is efficient exposure to the price of gold. It does have a long history of being used across the globe, and it does obviously have a diversification application for portfolio management. You can see I've got this price here, 163.13. So that's currently where the current bid offers are, thereabouts the price of gold. It is traded in US dollars, and the minimum transaction size for this gold ETF is just 5 units. So 5 units in the gold ETF is equivalent to the exposure of 0.47 ounces of gold, which means that with the price at $163.13 US cents, the minimum transaction would be 5 times that. So 5 times 163.13 US comes to $815 US, or 816 US dollars, which would be equivalent to the exposure of 0.47 ounces of gold. Moving to the next slide, you can see, just to share the workings of a gold hedge. If we had a gold hedge in place in 2020 through the 21st of May, if we assume an investor allocated at the end of 2019, 50% of their funds to the SPDR STI ETF, that's the Straits Times Index ETF, while at the same time allocating the other half of the funds to the SPDR Gold ETF. The investor, through to the 21st of May, would have roughly broken even. The STI units declined from $3.28 at the end of 2019 down to $2.60 a unit on the 21st of May. However, there was a small boost to the return, and that was provided with our semi-annual dividend distribution for that ETF on 10th of Feb. Had the investor reinvested the dividend, the loss would have been around 19.7% because the investor was reinvesting the dividend into a declining market. Had the investor banked the 6 cents instead, the 6 cents per unit, the dividend into the total return would have basically seen the loss in total return of around 18.7%. So had there been no dividend at all, the return would have been a decline of 20.7%. So you're looking at around just under 20% decline for the STI, whether you bank the dividend, reinvest the dividend, or say you didn't have the dividend. At the same time, but on the right side of the screen, you can see there's the performance of gold in the green line. The gold ETF gained from $143.45 US cents at the end of 2019 to $163.13, representing a gain of 13.7% in US dollar terms. But you got to recall that at the same time, the US dollar has appreciated over that period of time to the Singapore dollar, appreciating around 5%. Hence, the US dollar investment required for half that portfolio that we were investing in the gold ETF, it did receive a boost in terms of the appreciation or the additional gains of the US dollar to the Sing dollar. And it meant the overall return of the gold ETF was 19.6% in Singapore dollar terms. So the 19.6% return of the gold ETF has offset the majority of the 19.7% decline of the STI ETF. Had the worst case scenario, had the STI ETF investor reinvested the STI dividends. Incidentally, I will point out too, the STI ETF pays dividends, gold ETF does not pay dividends. And I guess one more final point to make on this gold ETF is that if you participated in the gold ETF market over the past 5 months, if you were, then you are in good company. Participation as measured by average daily turnover, it has tripled in the year to date, up to $6 million US in a day this year, up from just under $2 million a day in 2019. And we did see in March, when the volatility of the gold market, with all the indiscriminatory selling we saw in the 3rd week of March, with all that volatility in the market, we saw its volatility almost double from 14% to 33%. It was that month or that week, I should say, that we did see gold ETF volume soar, as we can see with the green dotted line, up to $10 to $11 million a day. So moving quickly on, so that's the first of 3 methods that investors could have used to hedge portfolios. The second, and I'll be as quick as I can, is defensive stocks. Traditional defensive stocks, they include things like healthcare, non-cyclical consumer stocks, utilities, some telecommunication type of companies. That is sectors that have a traditional history of being less sensitive to economic cycles. And the sector I'd like to just take, I guess, the next 3-4 minutes just to focus on is the non-cyclical consumer sector. Globally, regionally, non-cyclical consumer stocks have seen less declines than their peers in the 2020 year to date. In Singapore, when we're looking at all the returns of the top 100 stocks traded by turnover, the median decline was 22%. But if you look at the 9 cyclical consumer stocks amongst those 100 stocks, they averaged a 14% decline. Which is a similar defensive performance, relative performance we saw for this sector across the world. The 3 most defensive stocks of the 9 consumer plays over the past 21 weeks here in Singapore, they included Sheng Wun Group, Jatfa, and Wilmar International. Together, the trio averaged an 8% total return in the 2020 year to date, and that did also follow past defensive performances. We saw the trio average 22% average returns in 2018, back when the STI declined 7%. We saw the trio average a 1% total return in 2016 when the STI declined 11%. I might also point out that they did also report comparatively strong March quarter results. I think Sheng Wun Group reported a 50% year-on-year increase in net profit. Jatfa reported its revenue grew 4% year-on-year, but its operating profit was up 47%. And Wilmar International reported core net profit, I think, improved 23% year-on-year. So they were comparatively strong defensive results. But as I said at the beginning of the presentation, this is a purely educative example on just how some stocks have listed on SGX have seen a defensive pickup in their profit in the first quarter of 2020 amidst the onset of the pandemic. And we can take questions a little bit into this panel session if you like. But just to quickly wrap up, the third and the final method that I'd like to share for the presentation is how investors have hedged portfolios using index futures. And note, very important difference between index futures and the gold ETF is that index futures are for sophisticated investors. They are an SIP product, where gold ETF is not. As experienced investors, you would know most global indices like the Dow Jones, the S&P 500, the FTSE 100, the Hang Seng Index, they all have associated index futures contracts, which are highly correlated to the index. They are derivatives. They base their value, their derived value on that index. And here in Singapore, we have an MSCI Singapore index that is highly correlated to the Straits Times index. It currently includes 22 stocks, of which 21 are STI constituents, and it has a correlation rate of 98% or 0.98 to the STI. So it's very statistically significantly correlated to the STI. And the chart shows that. If you see the green line, that represents the futures contracts. And if you see the blue line, it represents the Straits Times index. So it does show a very strong relationship between the two markets. Now, just to give you a little bit of 101, index futures, they do have two important points on their application. The first is that they are leveraged. The second is that they all have expiry dates. And these key traits mean they are for the sophisticated investors. For the leverage part, CIMB futures maintain a current initial margin or deposit requirement of just almost $2,100. However, one position of holding in the CIMB futures, whether you have a bought long position because you anticipate prices to rise, or you have a short sold position because you anticipate prices to fall, if you have that position, it's equivalent to holding a $30,000 portfolio or basket of stocks weighed in line with the MSCI Singapore index. Hence, investors have access to the beneficial moves or the adverse moves of such a portfolio and can lose more than that initial deposit of $2,100. And then the second is, of course, they are traded on a monthly sequential basis. So if a short position was taken in the CIMB futures at the end of 2019 through to the May 21st, as the market has fallen, there would have been 4 instances that the futures position would have to be rolled over to the next month, i.e. from January to February, February to March, March to April, April to May. That can add to a transaction cost, especially if the front month is trading at a higher price to the forward month, which means you have to, basically, let's take the case of if you were short the contract and the April contract closed at 294.6, you would have had to buy at 294.6, while at the same time the May contract was trading a little bit lower. You would have had to sell that May contract at a slightly lower price of 292.4, and that would have represented a 0.7% cost. The previous roll would have represented a cost maybe of 0.2%. But it's just an important point to make. So the educated example of the futures hedge here would have seen 1 January CIMB futures sold on the close of the 31st of December with a futures price of 371.5, and the standard contract multiplier of $100 would have made the notional value or the exposure of that one contract at $37,500. The contract was then sold and shorted at that price of 371.5. Then here in May, on 26 May, assuming the position had been maintained with those 4 rolls, as we said, those contract successive rolls, the May CIMB futures was trading at 294.65. So applying again the standardized contract multiplier of $100 per one big point, the hedger would be buying back the position to close the short position at the lower price of 294.65. So the hedger sold first at 371.5, bought back at 294.65 for a notional value, that $100 multiplier of $29,465. So in the example, the hedger has sold the CIMB high, 371.5, bought back the position lower, 294.65, made a return of 21%, not including the transaction fees or the rolling costs, and then it's offset that decline of 21% that we saw in the STI as well. So much of the loss has been hedged by having the opposite position in the actual CIMB futures, assuming, of course, that the underlying cash position was a similar equivalent amount of $30,000. So as we say, it's all educative. As I've stressed, it's for sophisticated investors. We have a number of courses on the SGX Academy that do provide regular digital education. And I think I'm providing one on Thursday night as well with Phillip Capital, if anyone's interested. But to wrap up, again, thank you so much for the kind invite. to speak today. I will just say too that our team here, we do have here at SGX a number of multiple reports and insights that everyone here is welcome to subscribe to. We have regular content from our SGX My Gateway report, COPC interviews, the 10 in 10 short reads that are providing insights into SGX listed companies through a series of these 10 question and answers with management, which you may have read in The Edge and The Edge Prop Singapore. And of course, we've also got our recent launch of Telegram. So thanks again. And I really look forward to talking with you in the panel session as well. Thank you.
Thank you very much, Geoff. Before we move on to our next speaker, I would like to just give everybody an update. We have a total of 2,205 participants at the moment, and slightly shy of our STI. And so Mr. Geoff talked a lot about dividends, and our next speaker, Mr. Terence Wong, CEO of Azure Capital, is going to talk about, his topic is back to basics, capital gains or yields, stocks or bonds. Mr. Terence, please.
Trying to share my screen. Okay, thanks so much, Chloe. I'm just trying to share my screen right now. Let me see. Here we go.
Yep.
Okay, everything's good. I'm gonna power up the PowerPoint slides. Okay, good to go. Great morning, everybody. I'm always very excited to be part of the Edge seminars. I've been doing this for the past few years. And I think few people know that, I have a very, very long-standing relationship with the Edge. I mean, I've been a lawyer, subscriber, reader since 2002, but sometime in 2005, I was then in sales research. I had a joint promotion with the Edge. Many of my members actually signed on with the Edge, and when I first came back to do the seminar with the Edge many years later, I was pleasantly surprised. They are still loyal subscribers to the Edge, and these seminars actually give me a very, very good opportunity to meet up and reminisce about the past. That's why I like seminars versus webinars. But unfortunately, with COVID-19, we couldn't look, see, touch each other. But we'll make do. And I've been used to doing webinars over the last 2 months. I've done 7 of them, and I realized that webinars are not too bad after all. You can literally roll off your bed, just put on something, just put on a decent talk. Underneath, anything goes, or nothing at all. But for the record, I'm actually decently clothed the whole way down. But that's it. I think that the capital markets, the stocks, there's a lot of attention right now. And going back to what Uncle Song mentioned just now, these are really, really unprecedented times. And he's right. Every time I do a media interview or I do a presentation, I mentioned unprecedented 5.5 times. So let the ball start rolling. Unprecedented times because we are not allowed to be out of our house. We can't travel. And you can see the planes, SQ, 96% of them are mothballed in Alice Springs, in Singapore Changi Airport. Causeway, nobody traveling. It's not only the planes, but even the causeway is totally empty. And the last time it is this empty that you see on the bottom end of the screen was during 1940s when the Japanese actually cycled down to take over Singapore. And then shopping, nobody is doing any form of shopping. The screen right in the middle, that's at 3 p.m. I think in Vivo City. There's only one person out there. And this looks like it's 3 a.m., but it's 3 p.m. right there in the afternoon in one of the most popular shopping malls. The only places people are going is to the supermarket, Sheng Siong. Geoff mentioned about Sheng Siong just now. Everybody hold up at home and they're aspiring now to be master chefs. GDP obviously will go down, and I think that with the recent revision down to -7%, this is more like it. Earlier on, when they revised from positive down to slightly negative, -1 to -4, I thought that there's still some way to go. But like I said, with the recent revision, it looks more like it. Unemployment is likely to go off the charts. Some of the estimating that was in Singapore alone is over 100,000. I mean, in the US, it's already like tens of millions. In India, it's 120, 130 million people that's out of jobs right now. So, but if you look at the stock market, initially in the first month when we started to do lockdowns globally, it fell about 30% which seems right because these are unprecedented times, and therefore the markets need to react. But what happened after that was something that I feel is a little bit unforgettable too. Many of you, I believe, are new investors. So you may be very, very puzzled. Hey, we are into one of the worst recessions ever. In fact, people are saying that it could be even worse than Great Depression. But yet, since March, you can see the stock market's just bouncing up. Is this real? And this is particularly true for the US. US, you look at them, NASDAQ, Dow Jones, S&P 500, all jumping over 30%. In fact, I think NASDAQ is flirting with the 40% mark right now. Year to date, it is up, and Dow Jones, S&P 500 are just slightly down. There is indeed a real disconnect, and one of the reasons is because there's loads of cheap money. The central banks are just pouring trillions of dollars into the system, and with nowhere to go, many people are just snapping up stocks because they think it is cheap. And there's really, really high hopes that it's going to be a V-shaped recovery, though I wonder why people would think that way. Even though with the economies opening up, it's not like a light switch, right? You go in, you snap it up, and then the economy starts to suddenly starts to bounce up. It may bounce up significantly from the low because there's no activity in April, no activity in May. So when something happens in June, it seems like, wow, it's great. But then we're still way, way, way below where we were during normal days. And normal days, we're just talking about 2-3 months ago. And of course, there's also high hopes that there's going to be a vaccine because vaccine is going to save everything, right? But from what the experts are saying, the vaccine won't be here 12, 15, 18 months. And to be commercially available, that's the minimum amount of time that we are expecting. So vaccine won't come so fast. And what happened is that because of COVID-19, there's great adoption of tech. And this is essentially a tech-driven rally. S&P 500, which is broad-based, counts about fifth of S&P 500 is tech-related. If you look at the FANG stocks, they have bounced up significantly. The likes of Amazon, Apple, Facebook, Google, Netflix, all of them have jumped up since the March low, anywhere between 20% and almost 60%. These are significant, and that has actually boosted the likes of NASDAQ as well as S&P 500. And if you look at the S&P 500, speaking of S&P 500, it is now trading at the highest multiple since 2002. And if you look across the entire history, we are talking about the highest level since, actually the second highest level ever. So S&P 500, we are taking the PE right now is over 20 times, and it looks really, really expensive versus historical levels. And I feel that, over the horizon, there are some things that will actually break this rally. One is the second wave of infections. Geoff was mentioning, Jerome Powell, there's something that he's worried about, and this fear is real. There's also continuous weak economic data. I mean, right now we are thinking that it's going to be a V-shaped recovery, right? But what if the V-shape don't happen? Right, the third quarter, if it continues to be extremely muted, that is going to have, I think, issues. And the massive unemployment, already we are talking about 40 million Americans that are furloughed or unemployed. So these are records. People are not, the people are already feeling it on Main Street, but over in Wall Street, it is still we are still very resistant and believing that, the V-shaped recovery will actually help all these unemployed people. What if it doesn't? We did say that a lot of these furloughed workers will be back, maybe 50, maybe 60%. But from such a high levels, and even 50 and 60% of the people comes back to the workforce, there are still a lot of people that are not. And this may create social issues. And social issues, I do mean that, if they are hungry, they may go out there and they may, beg, borrow, steal. And there will be some destabilization when it comes to the economy. So that's something that I believe we have to watch out for. Look at Indonesia, for example. That lockdown would have created a loss of tens of millions of jobs. These guys, many of them are part of the gig economy. They are not doing very much over this period. They're not earning anything, but they need to put food on the table, right? If that's not going to happen, this will have, I think, pretty serious implications. And Indonesia, over the years, you can see that there is a propensity for, you know, like social unrest to happen. So that's something that we have to watch out for, because it is very, very close to our backyard. Many people right now during this period, we're also shoring cash up. Even despite the cheap money, they feel that, you know, the jobs are uncertain. The economy is going to be like really, really bad, right? So the next best thing is to really come together and then to put them to savings, even though they are earning next to nothing in the banks. They don't want to put into the equity markets anymore because of such loftiness. That is also going to create some issues. And I think that there will be some, and this is the final part is something that, you know, I don't get why the market has not reacted more violently. There's going to be renewed tensions between China and US. And in fact, we are really seeing that there are many, many potential flashpoints. Geopolitics is something I feel is maybe potentially more serious than the virus itself. And so I think that this is going to be very negative for the market. You know, when Donald Trump fired the first salvo in 2018, when he started to launch the trade war, we all felt it over here in this part of the world. In Asia, March 2018, we already felt the impact. But in the US, they didn't do, the markets didn't react, and didn't react violently until October 2018. As you can see from this chart, I'm looking at the STI in 2018, actually like nosedive. So the MSCI Asia, it went down quite a fair bit. And like I said, in the US, it was only the final quarter that happened. There's I'll go back to the same slide again that I shared earlier on. There's this massive great disconnect. STI is down, was down 30%, but it jumped back up 13%. Year to date, we are only talking about, you know, close to 20% down. But on average, you can see that it is significantly worse. The average period of a downturn is anywhere between 300 days to almost just above a year. But the average percentage fall is 43%. Year to date, like I mentioned, in STI is only down 20%, half of it. And remember, we're talking about one of the worst, possibly the worst recession that we've faced. And yet we have fallen a lot lesser. The impact is a lot more muted compared to what we have seen in the previous crises. And if you look at, so to me, what is happening right now, you know, coming off from a lows of 2233, this is essentially a bear market rally. And it is not uncommon to see bear market rallies. You can see over the years. In fact, over the last 20 years, we've seen a series of bear market rallies. And this can last anywhere between 2 weeks and over 3 months. Right now, we are into the second month of this bear market rally. We have gone up 12%, but like I say, it's not uncommon to see it. And over the last 20 years, it is anywhere, this bear market rally can be anywhere between 8% and 17%. So in the main, I think there's really no hurry to go into the stock market. Even for myself, I'm cashing up with the markets coming up. You know, I'm taking the opportunity to sell down some of my positions. And I think that, you know, in due time, the markets will look attractive. And if you think that there is a leg down, like what I do, I feel that it is good to stay somewhat in cash. Many people mention about the defensives. Geoff did mention a little bit about the defensive stocks. Those are a great place right now. But even if the market were to take another leg down, like what we've seen between end Feb and end March, that 1 month, everything got wet, even the defensive stocks. So my strategy is really to stay in cash right now. But when it comes down to more palatable levels, go in for I would like to live a little bit dangerously. I want to go in for companies that I believe do give you the big bounce up, because when the bounce up comes, it's not a matter of if, but it is a matter of when. When the market comes out, these front runners will actually ride the wave. Some people do ask about bonds. This was what the organizer asked me to do, to look into a little bit about the bonds, but just very, very quickly, because I'm not a bond expert, but I feel that it is always nice to have a little part of your portfolio. I mean, depending on your age, you have to have a part of portfolio in bonds, and Geoff mentioned about gold. I think that's a good diversification tool. There are few types of bonds here. I know many of you, I did see the demographics, about half of you right here are newbies. So the type of bonds that are, I mean, the government ones, that are the corporate bonds, that are the investment grade ones, and there are those high yielding, some people call it junk bonds, but not all high yielding bonds are necessarily junk bonds. Of course, if you look through, government bonds are the safest, but as I mentioned, it's good to have a diversified portfolio. You look at your risk appetite. Risk appetite would mean as well as your age. I mean, the conventional thinking is that if you are younger, you can take more risks, you go more into equities versus bonds. And if you get a little bit older, you scale down on equity because that's risky, and then you move on to bonds. But I want to warn people, bonds are not necessarily risk-free. There are many danger points. Think offshore marine bonds back in 2015, 2016, when the offshore marine market started to plummet. In 2013, 2014, there were a wave of offshore marine companies coming out with bonds, giving you very, very salivating yields, like 8%, 9%. But when the crunch time came, they cannot pay up, and there were massive defaults. And in recent times, we're already seeing somewhat like that. In Joe Energy, for example, they offered cash payments of $430 for every $1,000 of existing notes. And that is because there's only cash of about 80 million versus its outstanding was 154 million, which they pay back next year. They know they cannot make it. And so I think that this essentially, to me, is like distressed debt territory. So I feel that if you want to move on and go into bonds or fixed income, whatever the case, just like stocks, go with the safe ones. Unless some of these companies, they do offer very, very good yields, maybe about 9-10%. And you do understand the fundamentals. That is the basic premise. I always mention that you need to know what you're investing in. It happens for stocks. It's the same thing for bonds. If you believe that that particular company has very, very good balance sheet, because that's all you need to look at right now, right? That they have the ability to actually pay back, the loans that they took from you. That is important. Cash flow is very, very important when it comes to bonds. So make sure that you can analyze these companies, and preferably if they're listed, so that information is all the way out there. Some final words I have. I think that, like I said earlier on, for equity, if you're investing in equity, there are still many things that can go wrong with the equity market. There are downside risk involved. So the best solution right now is really to, I think, to cash up and wait for the markets to come off. And I think that this is going to be sooner rather than later. Something's going to happen with virus. I mean, the markets are really too frothy for its own good. And I feel that the US-China issue can turn big, especially because Donald Trump, he has all this rhetoric, and it will continue through his campaign period. And remember, the presidential elections are in November. So there will be, I think that there will be numerous issues coming up, and therefore it will be wise for you to really short cash, because I think that there will be good opportunities in the not too distant future. And if you want to know more about, I think, individual companies, onto my Facebook, you can actually ask me questions. For the record, I know when I for the Edge seminars, many people ask me, hey, can you help me invest? The unfortunate thing is I cannot, like I do institutions, I do accredited investors. But, over the years, I have I've developed a very, very close affinity ties with retail investors. I basically grew up with CRCR's research, right? And therefore, it is still something that's very, very close to my heart. So if you do have any questions that you're not very sure of, or you want to look at a certain stock, please feel free to come on, ask me some questions. Over here, I'll also be sharing, some of my, I do very frequently meet up with CEOs, the founders, for Kopi sessions, and it's a platform for me to share what the company is doing as well as some personal gossips. So, swing on by. I will hand the mic back to Koi. Koi, are you there?
Yes, thank you very much, Terence, for sharing your position. So next up, we have Alice. Ms. Alice Tan is the Senior Director, Research and Consulting at Untitled Company. And the topic she's going to cover is home is where the heart is. So I see one of the top questions is about Singapore's real estate. So Alice, I'll hand the time over to you.
Thank you, Kawi. Thank you to the Edge Singapore and the Edge Prop for inviting me to share on this very interesting topic. Let me bring you to my screen first so that I can get started. Can everyone see my screen?
Yes.
Thank you, Kawi. Let me just go to the presentation mode. Right, this topic is close to the heart of many of us, especially during the last 2 months where we have been spending a lot of time at home, working, studying with our kids, and learning as well. And webinars like this is great, thanks to technology that has enabled us, to share our insights. And all of you, over 2,000 participants tuning in to listen to our sharing. And we look forward to the question and answer session later on. And regarding this topic that is very close to my heart as well, we want to share with you, how has been the private residential market been trending. And I'll touch on a little bit about what's going to happen for office and hotel outlook, in the wake of the COVID-19 pandemic. So there are 3 issues that I'd like to share. First is, in light of the pandemic and the economic slowdown and very bleak market sentiment, which, our 3 other speakers have quite touched on a fair bit, what are some of the other drivers that drive our private residential property market? And with the COVID-19 pandemic and new normal of the way we work, live, and play, will there be any expectations of our new home being shifting? And what would be the next up for hotel and office when the circuit breaker and COVID-19 pandemic ends? First up, about the key drivers for the residential market. Let's recap on what has been the private residential property prices been trending for Singapore for the last 20 over years. The chart over here shows you very clearly that for any financial crisis, the decline can be very steep, such as the Asian financial crisis, where our private home prices have declined by 37%, and our global financial crisis has declined by 25%, and also due to 9 rounds or even 10 rounds of property cooling measures from 2013 and to date, prices have corrected by 12%. But in light of all these crises, as well as pandemics like SARS and H1N1, our private residential prices seem to rebound. And when it rebounds higher and longer. After the Asian financial crisis, our home prices increased by 40%. And we had a slow, flattish home market from the year 2002, after the World Trade Center collapse and attack by the terrorists, all the way to 2006. Prices have been trending sideways. But however, after our government implement a series of supportive measures to support our economy, ranging from the 2 integrated resorts, and our economy was humming along very well because of the global economic boom. Our prices increased by 58%. And that was when our home supply was low, and that propelled a spike in prices. After the global financial crisis, that corrected prices by 25%. Our private home prices increased by 62% for over 17 quarters due to the low interest rate. And this is happening despite the EU debt crisis from end June to end 2009 and 2012. And during the whole series of cooling measures that started in 2013, because the government needs to ensure that our prices don't escalate further, our home prices corrected by just 12%, very slowly over 15 quarters before we see a recovery since 2017. And now in Q1, we finally see a fall due to this weakening economic sentiment. So with this recap, you notice that for these last two crises, the Asian financial crisis and the global financial crisis, the decline lasted for about 5 quarters for AFC and 3 quarters for GFC. But when it rebounded, the number of quarters of increase is higher than the number of quarters of decline. Let's have a recap about what has been the last two pandemics and the current pandemic that we are having, and the impact on our Singapore economy, as well as our private residential prices and rentals. During SARS period, the number of infected cases were far less worldwide, only about 8,000 over cases, but the mortality rate is high, close to 10%. And for Singapore, we are also seeing more than 10% mortality rate, although our infected cases were less. And our GDP growth managed to recover well despite the pandemic, and we clocked in a 4.5% annual growth in 2003. But our tourism numbers have suffered a fall by 19% annually in 2003 because people were fearful of traveling, especially into Asia, where SARS was raging on in Asia back then. However, our private residential home prices did not seem to register a big decline. It was still trending at 2.1%, and our rental prices actually suffered a decline as well. So actually, you can notice that our home market did suffer a decline during the SARS period, but it recovered quite fast, which I'll share in detail later on. For the H1N1 pandemic, it occurred right at the aftermath of the global financial crisis that occurred from October 2008. But the number of infections were very high. The number of cases, as I look at the World Health Organization reports and all, there was no clear known total number of H1N1 cases, but it was kind of estimated that it could be as high as 700 million. And the number of deaths was much lower. The mortality rate was much lower for H1N1. And same goes for Singapore as well. Our GDP growth was just moving at 0.1% because due to the aftermath of the global financial crisis, tourism visitor arrivals fell just slightly by 4.3%. Our private home prices recovered very fast in the light of the low interest rates, and the home market is not directly affected by H1N1 at that point in time because it coincided with a major global financial event. And right now for COVID-19, the number of cases, as we now see in the news every day, is climbing very fast, especially at a global scale, where the number of infected cases is 5.6 as of 2 days ago. And the number of deaths is already crossing 350,000. Singapore, we have 30 over 1,000 cases, mainly from the worker dormitories, and the number of deaths is now at 23. And recently, MTI released our latest GDP figure. It is a minus 0.7 year-on-year correction. Thanks to pharmaceuticals and the manufacturing of essential goods such as biomedical and pharma, and that helped somewhat to support our economy from declining further. But look at our tourism numbers; it has declined by 43% in Q1. And our overall home prices dropped by 1%. Rentals have actually increased because a lot of gas, especially overseas gas and expatriates, they couldn't go home. They have to stay in Singapore. And also due to some temporary accommodation needs and even quarantine needs, the demand for rentals actually has increased. And let's recap on what happens during the last 3 pandemics, whereby has there been any impact on sales volume. During the SARS period, it actually corrected by 41% during the peak of the SARS pandemic. Whereas for COVID-19, so far in Q1, it has declined by 12.5%. But it's at the start of the circuit breaker, just before the circuit breaker. So the impact has yet to be clearly seen. But what's interesting from here is that after the peak of SARS in Q1 2003, all the way to, sorry, couldn't see my words there, but okay, you can see it on your end, that it has increased by over 56% all the way to 2008. That was just before the global financial crisis. So that actually has created that just hang on for a sec. Let me just adjust my view. Okay, okay, right. So it is clear that when a pandemic ends, and with many other overarching and macro factors that may support the economy, equities market sentiment, it will also lead to support to private home sentiment thereafter. Although it will take some time, but during the SARS period, it is actually quite telling that after SARS ends, and over time, like 5 years, prices can increase as high as 56% during SARS. But right now in COVID, COVID is a totally different pandemic. Is far more worrying compared to SARS due to its highly infectious level, and the number of cases are still increasing worldwide, and we are still not out of the woods. But if we look at during the SARS period, after the peak of the outbreak, the sales volume actually rebounded. It exhibited a V-shaped recovery, and it has increased by 147%. And sales volume is almost 3,500 units, both for the new sale and the secondary market. And what's interesting is that when you look at the private home price index, quarter-on-quarter drop, it is less than 1%. And it goes to show some resilience, even during the height of the pandemic back then. And after when SARS kind of go to the tail end, prices started to recover. So all in all, the SARS outbreak has led to like almost a 6-quarter price correction, but the price correction hasn't been very steep quarter on quarter. So in a way, it is less volatile in terms of the private homes prices. And if I draw a relationship between equities market and private home prices, just to compare, how trends are going in different times of the year for the last 20 years, you will notice interestingly that during SARS, STI actually increased by almost 30%. My fellow speakers will be able to give more insight on that, during what happened during SARS. And our residential prices corrected by only like less than 1%. If we compare just year on year from Q2 03 to Q2 04, and it appears that equity seems to recover within 2 quarters, that's 6 months from the outbreak of SARS, while private home prices took about 6 quarters, that's more than a year before it starts to recover. So private homes tend to exhibit a laggard trend. That's expected because private demand is kind of like a derived demand. It depends on how the economy and equities market perform. And now during SARS, during COVID-19, we see that the STI index have actually corrected by quite a big margin, with most counters dropping by 20 to 30%. And it might be a telling sign for what's going to happen to the private homes prices thereafter. And one very important driver that drives our private homes is actually low interest rates and high liquidity. Over the last 20 over years, you can see that the M1 money supply, which is the most active and easily accessible money supply, has climbed tremendously. And our 3-month SIBOR has also been declining very steeply since the global financial crisis in 2008. And since then, our SIBOR has been just climbing up very slowly, and it was reaching about 2% in 2019, at the start of 2019, before it starts to come down. And due to the COVID-19, interest rates has now come back down again. What we are reflecting here is as of Q1, but now in almost at the start of June, in fact, the SIBOR rates have gone down below 0.5%. So with this low borrowing cost, it actually helps to support borrowing decisions for home buyers who are serious to buy property right now. And for our URA private residential prices for non-landed and landed, even though on a quarter-on-quarter basis, it has exhibited a 1% quarter drop, But for year-on-year basis, right, it is interesting to see that the non-landed prices still rose by 2%, and the landed prices rose by 3.6%. So year-on-year wise, it has been exhibiting positive growth since 2017. And how about sales volume in new sales and secondary market? What's telling here is that, if all of you could recall, during July 2018, our government rolled out 10th round of cooling measure where they increased the ABSD for second-time home buyers and foreign home buyers. That has actually caused a decline in sales volume in Q4 2018 and Q3 2018. So you see that there's a 20% and 30% drop, but it recovered very quickly within the next 2 quarters. In Q2 2019, it has recovered by almost 20 and 30%. Before in Q4, we start to see a drop. For Q4, usually at the end of the season, sales volume tends to be a bit slower, due to seasonality impact. But Q4 2019, just last year, was a time where US-China trade tensions were impacting on economic growth around the world, including Singapore, and that has caused some impact on market sentiment towards property investment. And also developers were holding back launches in the last quarter last year. But in Q1 2020, developers were also rolling out less units for launches. But our secondary market has dropped slightly, and therefore overall it has dropped by 12%. But in terms of proportion, it's about 50-50 between the new and secondary market. And another important statistic that I would like to showcase is on our unsold stock for private homes. This is important data, which recently developers are also talking about it, and the government is also monitoring this. And what's interesting here is you see that during the 2011 to 2013 period, this is where the property market was having a boom. Low interest rates, many people are going into the market, and land supply was slowly cutting back by the government towards 2013. And because of the slow land supply from the government and inactive collective sales market, where developers were not looking at collective sales market at that time, overall land sales has actually dropped, and that led to a drop in unsold stock. And it's only during 2017 you see that the unsold stock is at an unprecedented low, and that actually propelled the demand for land, both at government and private collective sales. And with replenishment of land bank by the developers, that led to an increase in the unsold stock. But now unsold stock is now starting to reduce, even for Q1 2020, and also because for the last 2 years or so, since mid-2018, where collective sales have been frozen because of the cooling measures, land supply has been falling again. And with unsold stock going to likely fall further, it's just depending on the rate of fall. We could see, at such time, before, prices may go back up again, unsold stock may go back up again as developers are looking for land to replenish. Let me look at the buyer profile, where who are the buyers so far, for the last 4 years. Singaporeans still form the majority of the home buying activity, island-wide, for non-landed property. But for sales volume, you will notice that in Q1 it has registered an overall fall. And for foreign home buyers, which is the PRs and the non-PRs, we also see that sales volume has dropped by about 20% in Q1. That is expected because of the looming pandemic and increasing travel restrictions. And there's one statistic that is interesting for me to share with all of you, is that April 2020 is actually during a time where we have our circuit breaker. And how has been the sales volume so far compared to the previous month? What I'm showing here is Q1. But in the previous month, in March, for instance, for new sales, new sales for April, has declined by almost 60% compared to March. That's expected because of the closure of show flats. Physical viewings are not allowed. Agents cannot do, could not show, even resale homes to home buyers. So activity in April and even May has been really slow in terms of viewings and all. But despite this constraint, right, we still can see in April there's a total number of 500 over units being sold, which is to me pretty encouraging. At least there's units being sold, and there's more Singaporeans buying at 81%. But But when you compare with prime district, traditional prime district 9, 10, and 11, 82% of them are Singaporeans, and you compare this proportion of overall buyers for traditional districts with island-wide, the proportion is actually increased to 27% compared to 12%. What does that mean? Does that mean that people are actually looking at prime districts and to take opportunity to buy when everybody are fearful? Potentially so. And the top 5 foreign nationalities has been the Chinese, the mainland China, Malaysia, India, and Indonesia. A quick recap about what's my view on what some potential shifts or expectations for a new home. What I would like to recap is on how prices are trending by the 3 main market segments which URA carves out. The central region comprises District 1, 2, which is the downtown core area, and part of District 6 and 7. Traditional prime district 9, 10, 11, and Sentosa, that's your CCR. Rest of central region is the one within the black boundary, which is central region, outside of CCR, and outside central region, that is the suburbs. How has prices been trending? In terms of CCR, you will notice that in Q1, if you compare prices on a year-on-year change, it has declined by 7%, but a lot of these prices are very sensitive to what are the type of projects that's being launched. In the prime districts, right, if we compare in Q1 2019, a lot of the projects that were launched at that time were very prime districts, District 9, 10, and freehold tenures. And now when you compare it to Q1, because some of the projects that's launched were leasehold and not in the best prime districts, and therefore prices were lower, and that explains the 7% drop. But resale prices are also showing a slight drop, but still rather stable. Though Q2 so far, the numbers are still not fully in right now. But if we look at Q1, the volume has dropped slightly for resale. For the city fringe area, prices have gone up actually for new sales by 6.1%. Sales volume has declined slightly. As for resale, prices are still holding up pretty well and exhibiting a marginal fall. And in the suburbs, which we call it OCR, prices are still going pretty strong, with new sale prices going up by 4.1% as of Q1, and resale is also exhibiting a very marginal drop. So you can tell actually that buyers are buying based on needs right now, and also affordability. City fringe and suburban homes tends to offer lower prices, and that attracts the HDB upgraders, as well as the some of the private home buyers want to look at some other choices. Whereas high-end market seems that there's an increase in the proportion of home buyers comparing with island-wide buyers for prime districts. So these trends are pretty telling. It also shows that the market is still moving, although much slower due to the circuit breaker. And physiologically, due to circuit breaker, we stay at our homes most of the time. We are going to change how we expect a new home to be. It's going to be a very essential space for sanctuary, alternative workplace, and a pastime. So we want to have a layout that's able to have a nice design for study area. Balcony becomes much more important. We start to appreciate balcony even more. Parks and gardens is very important because this is the only limited place we can go, especially during circuit breaker. And I don't think people will stop going to parks even when we resume activity, because we find a lot of solace, a lot of calm and quiet when we go to the nearby parks, although with our mask on. And surrounding amenities become very important for us, because as we limit our commuting, we want to just go downstairs to get our necessities. So these factors will become more important as home buyers look for the new home. Now I go to office and hotel. This is also very much talked about, especially I noticed there are some questions asking about office. Okay, our visitor arrivals for Singapore. Q1 is expected is a big drop, 40% compared to the same quarter last year. This is due to travel restrictions. And how about our hotel market? RevPAR, we call it revenue per available room. It was about an average of about $190 last year. Now, as of Q1, it's $130, a big drop. And that is expected due to a fall of visitors and guests. In terms of occupancy rate, on average last year is about 87%. It was doing well. Hotel has been doing well. as we hit record visitor arrivals as of 2019, but now it's at only touching 59%. Okay, why would I want to share about how are China's travelers thinking about after COVID-19? Because China is the earliest to get the pandemic, but they are also the earliest to resume economic activity and travel. Some countries are now exploring what travel bubbles, where certain countries can accept nationalities from certain countries and ensure that there's less infection. And so understanding what the Chinese travelers are thinking, right, is a good indication, although not totally. McKinsey has done a study, and this study was released just 2 weeks ago. They surveyed 1,006 travelers, and these travelers actually say that a small proportion of them want to take a trip in the next 3 months. That's like by September. And 25% of these 1,006 think that they will go international, although a majority of them will still travel domestically within China. 5% will go to Southeast Asia. They still want to go for food and family destinations. But there's one very important trend that is telling, and for hoteliers to think about, is before COVID-19, 66% of the travelers want to travel with family, but now it's the reverse. 69% want to travel alone, probably because safety factor and also less of a hassle, in the light of pandemic is still ongoing. So what are the hoteliers doing? They are fighting on, and many of the hoteliers are also stepping up on alternative revenue channels and also helping the country by providing support for quarantine and COVID-19 related purposes. They become a very important accommodation for this purpose for the country to fight the pandemic. And also some hoteliers and service apartment operators are working to attract more long-staying guests, such as pre-existing lease and lease extensions, because a lot of these guests, they cannot go back to their countries. They have to stay in Singapore for some time, and that provides some revenue resilience for these operators. And now cleaning standards become much more important for hoteliers, and government has come out with this SG Clean certification, and 85 hotels have registered to actually take part in these cleaning standards. And this will actually put hotels in greater demand, because they want to go for cleanliness, over other forms of accommodation. And hoteliers can actually use this downtime to rebuild and revamp themselves for the next upturn when the pandemic subsides. Now I go to the office sector. How has it been? Actually, our office market has been doing okay in terms of net absorption. That means the new demand for new office space. It was doing well in 2019, especially for the second half. But in the Q1 this year, there's a negative net absorption, as you can see in the green bar. Occupancy rate has fallen to 89%, and there's a huge supply this year, due to new buildings being completed. What could be the impact on office demand going forward? Before I touch about that, let me look at strata office demand, where, when we look at Q1 strata office demand, it has fallen by about 28% if you compare average quarterly demand in 2019. And but yet you still can see 57 caveats, most of which it's a mixed bag from big units to small units, but still mainly within the central area and the central region of Singapore. But the average prices of strata offices have come off. Now it's about 2,000. Buying strata office has its benefit, whereby you don't have to pay ABSD. But however, it is a specialized asset after all. Buyers still need to know who are you attracting to in terms of tenants, and now will office demand still be there? I would think, my view is that going forward, there will be a hybrid work style where companies will be thinking about giving a combination of work in office and work from home, and therefore the role of office will have to change. What will be the office space be used for? It will just not be a space where you go there and do your desktop work. I think that companies will want to make use of office space as an encounter, as an opportunity for colleagues to interact, socialize, and learn. I think the face-to-face interaction is still very important, and there could be some psychological impact arising from circuit breaker, and there could be people dying to go back to office to meet everyone again. So there's some reconfiguration of office that's needed for corporates. So there will be a time where this needs to be done.
Sorry, Alice,
okay, this is my
to
last
interrupt
slide.
you. Okay, great, thanks.
Last slide. Yeah, I know the time shortage. So my main message is this: The demand for office, hotel, especially for private residential, largely depends on how the economy pans out, which in turn depends on how the pandemic is being controlled, and also arising from the other measures as well. Okay, so with that, I end my sharing. And if you have any interest to ask us more questions, feel free to drop me an email. My email is over there. And also feel free to also contact my research team. And feel free to visit our website as well. We have quite a lot of insight papers on our website. Over to you, Howie.
Thank you very much, Alice. Now, before we go on to our panel discussion, that will be moderated by Dr. Boaz, let's catch a short break, a minute break. Let's see you back at 11:37:38. And can I introduce Dr. Boaz Boon? He is the Director of Trinity House Investments. Dr. Boaz, please.
Yes, thank you very much, Kelby. Today, this morning, we have got lots of perspectives shared by our speakers. I thought that I summarize it under 3 Ps before we go on the question. I think that what I've heard so far, it's pessimistic, the first P. The second P, we need protection. The third P, we all need much prayer. All right, so with that, let us go straight in to the questions and answers. I would like to look at the first part is geopolitics. And then after that, we'll go to work from home and so on. So from this geopolitics and perfect storm situation with COVID, we have this US, China, and now with the Hong Kong thing thrown in, and of course, government debt and company debt will be increasing. So with this, especially the geopolitics of US, China, Hong Kong, let me just get a view from our panel speakers with regard to this equity stocks. And just now, Terence was saying that, this could be a bear market, and we just might have 1 more month of window for this bear market. So with this perfect storm that is before us, and with Warren Buffett selling away much of his aviation stock and so on, and kept his cash and not buying at this moment. So can I get a flavor from you guys? We'll start with Uncle Song first. So should we sell our stocks and just keep cash and wait for the thing to tumble further? So Uncle Song, what do you think?
I get my gin and tonic first, and then I
yes, your gin and tonic will give you much wisdom.
More seriously, since this is a bumpy road ahead, we've got through the first shock, i.e., the lockdown. Now we are seeing lights. We are seeing green shoots. But obviously, as been mentioned all through, I think the whole morning, it is an uncertain recovery, and you do have, as you said, risk on the geopolitics side. And I think where it'll get interesting will be when we get into the next 1 or 2 reporting season. I think analysts are really flying blind here with regard to how unfolding recession have or going to impact earnings. We have very little visibility. It's just simply hantam at this juncture, looking back at the last 1 or 2 crises and seeing what kind of prices and levels were reached then, and then assuming the same thing can happen. Not wrong, it provides a little bit of a window. But as we said early this morning, since we are in unprecedented territory here, unprecedented recession environment and unfolding, we really don't know how things are going to be hitting individual sectors and industries. So I think I will sort of pass it back to you and say, I really don't know. I'll just say, save some bullets. If you're a trader, trade. If you're not, update I need, be safe and conservative, take whatever it comes with you, and then that shall be it.
All right, thank you, Uncle Song. And Geoff, what is your perspective on this? Sell now, cash, buy, keep?
Well, the global stock market is really diverse. I know we have one of the world's most diverse stock markets here in Singapore, but just to look at the global picture, there's certainly been markets that investors have been able to rotate to this year. I mean, Zoom that we're talking to with our more than 2,000 participants today, that reports its numbers early next week, and that stock itself is up more than 160% this year. So there's just want to first throw out there in terms of that protection, that second P per se. There are portfolio products or different segments of the market here closer to home, very much like like Song was saying, the numbers aren't good. I mean, we were really resilient in the first quarter to only report, I think, our GDP down 0.7% year on year. But the key takeaway was the forecast for a decline of down 4% to down 7% year on year. But if you look in, that's the broad picture. But if you look into the components and look in the industrial production numbers that also came out last week, that was led by manufacturers of medical supplies, biopharmaceuticals and so forth. And we've seen that resonate and transcend somewhat into our stock market. Our manufacturers of medical supplies have been very vibrant this year. I think, Riverstone Holdings, EG Healthcare, Top Glove, they've all seen their share prices double. And then you've got a number of other companies like Biolytics, Clearbridge, Hyphens Pharma, Healthway Medical that have also lodged double-digit gains. And, some stocks have really come alive. I think Biolytics, it ranked outside, it's ranked just outside the top 50 stocks by turnover in year to date. And that's a very small stock. Since it's announced its COVID-19 rapid testing kit on the 30th of March, its turnover participation has grown 50-fold. So there's a lot, I guess, going on in the market as well. But on the final point too, not to take away from the broad weakness, we're also doing a good job here in Singapore. We've got, as we said, the GDP expected to decline down as much as -4% to -7% for the whole year. But we've had unity, we've had resilience, we've had solidarity, and we've had fortune budgets. And that's providing fiscal stimulus around 20% of our GDP. And if you compare from a global perspective, you look at the global GDP pie and you compare the IMF's, it's IMF's total fiscal stimulus in support of COVID-19, that is generally around 10% of GDP. So we're definitely putting as much as we can to work here in this economy to see ourselves through the year.
Right, thank you, Geoff. And so Terence, you're still on this, that is sell all and just keep cash and wait for the bear rally to just fizzle off?
Hey, hey, Boaz. I think just for clarification, regarding the month, I was just saying that, this bear market rally, lasts anywhere between 2 weeks and 3 months. I don't know how long this bear market rally is going to last, but I think that it is towards the tail end of it because there are a lot of negative pressures out there. And I am sure that the US-China tensions will play a major role. It hasn't done so yet. It has puzzled me because we have some history to look at. In 2018, it was really, really bad. And I think that there will be implications, with the security laws that's going to be passed in Hong Kong. Yesterday, or just a few hours ago, Donald Trump did say that they're going to take basically all the special rights with regards to Hong Kong away, and we're just awaiting that. I think that, Hong Kong will react negatively to it, and Hong Kong is one of the key bellwethers of the Asian markets. So I think there will be some knock-on effect. But looking at it from a midterm perspective, like what Uncle Song said, everybody's flying blind. And the worst thing is, I was an analyst for like 15 years. We typically are very, very slow when it comes to reducing or cutting estimates. So the earnings forecast, I think, is still too glowing for its own good. And I think that in the next quarter or so, there will be further clarity. There will be more cuts, and these cuts will be drastic. And I think that could bring the markets down a lot lower.
Yes, thank you, Terence. And you mentioned just now about the Hong Kong factor. With Hong Kong being wet, will that be slightly positive for Singapore, relatively speaking?
Okay, there are really two ways to look at it. I mean, one of them, I know that last year when the rise started to break out in June, people were saying that, there's going to be a flood of money coming into Singapore because, we are basically twins, right? So if whatever is bad for Hong Kong's people be transparent, and that has happened. So that's true. But if you look at where it's going to hurt most will be, I think, at least the front line of the first level of it, the first tier of it will be the manufacturers. In Singapore, we have a lot of manufacturers that is headquartered or they have their facilities over in China. And should there be a pullout between Americans and some of the Japanese and Japanese are really talking about like pulling out the factories from China. The supply chain in the near term, I think will be disrupted. A lot of the facilities will feel it, and the manufacturers, and this will hit down to the manufacturers that we have in Singapore. I think that they will feel the impact too.
So the manufacturers in Singapore will be feeling a great negative impact.
We saw that in 2018. They were the first guys to get hit because when, like I said, Donald Trump came up with this trade war back in March, the first guys that felt it were not the blue chips. So the STI was still like soldiering up. I remember in 2018, it was only in the beginning of May 2018 did the STI start to turn down from 3,600. But the small caps, a lot of them were the manufacturers, felt the biggest impact in March, right when Donald Trump announced.
Yeah, so that'd be a great impact to the manufacturers and especially the SMEs and the smaller ones. Thank you, Terence. And Alice, with this perfect storm and also with this geopolitics going on, just now you mentioned that during the SARS period, the residential property prices were not that badly hit. But this round, will it go beyond minus 10% for 2020 and the near future?
Well, this COVID-19 pandemic is a lot more different compared to the previous SARS, where right now the whole property market is affected by circuit breaker in a very big way for 2 months. And for residential market, it has been affected by the lack of physical viewing at show flats and also at homes. So what could lead to a steep price fall will depend on how our jobs market be performing in terms of job security, income growth, if there's any. In fact, more and more people are suffering pay cuts. So this would inevitably affect, the affordability of home buyers. But the fact also remains that, there has been a lot of built-up liquidity ever since 2013, where the total debt servicing ratio was in place. Many home buyers were holding back, although quite a number of them have started to commit in recent 2-3 years back into the property market. But there's quite a lot of them still waiting at the sidelines for the last 6-7 years, waiting to commit. So when prices are now starting to soften, as we have seen in Q1, and in Q2, there's the likelihood that prices may soften. The extent of softening, in my view, would not be too steep. Reason being is the sellers right now are still holding on to their prices because interest rates are low. Many of them are still able to service their mortgage. So sellers are not in a hurry to sell. And in light of that, there will be a price mismatch between buyers and sellers at this point in time. There's a tussle between buyer and seller, so prices will like hold or exhibit a slight drop. But the second half of this year is critical because we have to see if our jobs are still being maintained, incomes are still intact, home buyers are still able to service their loan or not. and also whether our government support measures are effective to keep our jobs. I think second half is critical, and it all really depends how our economy pans out.
Thank you very much, Alice. Uncle Song, with regards to job, with regards to the budgets and that have been coming up to help, in your perspective, will it really help jobs in Singapore and wages and affordability in housing? Because this may impact the prices of residential properties. So your view, please, Uncle Song.
Very much so. I think it's really all tied back to obviously confidence affecting morale. Obviously, morale depends, as Alice pointed out. We all know it's the underlying, whether there's money in the pocket coming in regularly or whether it is smaller. So all the budgets measures taken together really is about trying to cushion the economy. Remember, this is a very small open economy. If people cannot travel, if external demand condition remains very vulnerable to factors as Terence had pointed out, whether it's geopolitics, it's Donald Trump, or whether it is just second or third wave of infection, it might be lower, but it's still affecting confidence, then it will still ultimately impact Singapore because we are part of the global supply chain, global manufacturing, hubs and services for all kinds of activities. So if the confidence factor remains stable because the measures taken to date are able to cushion many businesses, still be able to retain, but nonetheless, businesses have failed. And so we are seeing, and we will see a pickup in unemployment. We have seen some numbers. Some of my fellow economist friend in other places has estimated that jobs could be in excess of 100,000. It's quite easy. I mean, Singapore resident labor market, about 2.3 million. So if you're looking around, let's say, the last peak in jobless rate, about 6%, you are talking about 150,000. But if you know that it is heading in that way, government is rolling out with measures. You know, what can be done, as Alice also pointed out, the next 3 to 6 months, very critical. If we do see people shuttering after turning the lights on this weekend and into next week, and jobless rates start to creep up, perhaps the measures can be fine-tuned again. The job support scheme, where 75%, it could be raised. So the bottom line really is about containing the damage. I mean, containing the damage is all about jobs. Your job, my job, friend's job. If they can, then I think we are already able to do, I think, a great job to keep it from going to that 6%, to keep it going to the 100,000+ of unemployed. Whether we get there or not, obviously, depends very much on, I would say, government everywhere, Singapore including, will be doing rolling packages, essentially rolling with the punches.
Yes, thank you very much. Thank you.
We can cushion the worst impact, especially on businesses and labor market, by providing more support and helpline.
Yeah. Thank you very much, Uncle Song, for that. And I'd just like to still keep to this theme on stocks. Geoff, you mentioned about Spider Gold ETF. Questions would be that, should we still go into Spider Gold ETF? Or could we even go into oil ETF? I mean, risk takers. So what is your take on that? Is gold price already so high up?
Well, that all depends on the investor. That's a tough one to answer because obviously in our marketplace, we have a number of remisiers and brokers who will then look at what the investor has in their portfolio and whether they do need gold. And it also depends on the view that the investor and the brokers have together. You know, if there's going to be a lot more uncertainty, a lot more volatility, then yeah, it does potentially offer that diversification element. But it all depends on, obviously, on what happens from here. Obviously, there are a number of risks, and as you were saying, just to add on to, I know you want to keep the focus on stocks, but the economy is so important. You look at our Straits Times Index, okay, and I know we talked about correlation of oil to Straits Times Index, much stronger. Gold, not strong at all. But you look at the Straits Times Index and you look at GDP, there is definitely a casual directional correlation between the two. So, you know, I guess it all depends on the economy, and that all depends on how we do it. And look, job creation, job preservation, it's clearly the first order of business with these budgets, and that really came out very strong in the Fortitude budget, with the creation of 40,000 positions in the public sector, bringing forward some targets and so forth. That is the way that we're going to be as defensive as we can economically. And I think just one more important thing that we can lose, a little bit in oversight too. Well done to the Edge and the Edge Prop. Well done to all the media in Singapore who have done a really good job, effectively, getting on with the business and making sure every single facet relevant in these fiscal stimulus measures are effectively communicated to all their readers. I think the Singapore local media has done a really good job in making sure all the measures are known, because we need to know these measures, particularly SMEs, particularly very small organisations that don't have much cash flow. So as I say, we just got to, for the economy, keep doing as much as we can to make sure, we move together in this. And then, the results you'll see the results in the stock market one way or the other.
Yes, thank you very much. Terence, I'll come back to you. Probably this will be the final portion on just looking at the stocks. Geoff mentioned that the SDI GDP very much correlated, and it's all going downhill. So, Terence, will the stock market test a new low to what we have seen in the past month?
Okay. The thing about GDP and SDI, I've done like correlation tests before. Typically, the markets tend to bounce up for the GDP is at its worst. So, give you an example. Let's say in 1998, the pits, or at least the worst part of it, in August 1998, and the market started to bounce up very, very significantly. And it took a few quarters before, we got back to some normalcy, and then we saw the GDP grow in 1999. But the market is always forward-looking. So that's one. So don't be too surprised when things are really, really dark, the market starts to bounce up. But in this case, I think that the bounce up is way, way too soon, because we don't know what's ahead. Like I said, third quarter could be as bad as second quarter, and second quarter, everything is shuttered, right? Or the good part of the second quarter, everything is shuttered. So to test 2233, I don't think it's unfathomable. I feel that there's a good chance that we're gonna move down that direction. It may even get worse, because like I said, there are certain events that we may not even think about. Back in say March, not too long ago, remember oil prices started to plummet, and then that really and people started to talk about coronavirus, and that was when it started. The black swan event was really the oil price. Going ahead, there could be many other different black swan events because of the virus. And you add on like what we mentioned about the geopolitical risk, which I think is very real and not fully appreciated by the market yet. Good chance that we're gonna revisit the lows.
Yes, thank you very much, Terence. That's very inverted comma comforting. And it's going to test a new low and probably going even lower. Now, let's move on to the next big topic, that is work from home and travel, all the restrictions, its impact on, let's say, Singapore REITs. Terence, start from you.
Okay, Singapore REITs, there are really many, many different subsectors, and I don't want to take up all the time. I see it's like 12 o'clock and there's a few other speakers. I'll be talking about...
Resilient? Yeah, which one is most resilient? Which one's
okay,
most
the resilient ones are, okay, the healthcare. But healthcare, you must be very, very wary, because there are only like two healthcare stocks, and both are very, very different. One is Parkway Health, which is seen to be very resilient, very stable, and the other one is First REIT, which is Indonesian, owned by Riyadis, and it's not exactly... So there's a big range. But if you use Parkway as a benchmark, it has been relatively stable. Industrial REITs, another one that has been stable, but both of them are trading at very high price to book versus, say, the retail, the guys that are feeling it the harshest, retail REITs as well as the commercial REITs and hospitality, of course. Hospitality the worst, but I'm going to give a talk 2 days later with SGX, and I'm going to explain more about these REITs, but you can host that. And the guys that I think will benefit, the REIT that will the REIT class that I think will benefit may not necessarily be the ones that are the most resilient right now, the industrial REITs as well as the healthcare REITs.
Sorry, which REITs again?
Okay, the industrial and the healthcare REITs, because it is, I think, over-owned right now. I think when you want to ride the upturn, possibly you may be looking at some of the REITs that have underperformed the market. Because remember, if you invest at the peak, the pits, the returns will be the most generous. But I don't think that you should put your money in right now. But I'm eyeballing hospitality, because if you look at it vis-a-vis the two REITs that have done, the two subsectors that have done exceedingly well, they're trading at like 1.5 times price to book versus 2 times that for the likes of the industrial REIT. So there's a big discrepancy, or not 2 times, one plus times. So there's still a big discrepancy. And I think that, when the markets start to recover, the economy start to open up, they'll benefit, but not just yet.
One last question, Terence. If those are holding onto S-REITs and even the resilient ones that you're mentioning just now, like industrial and healthcare, should they sell it because of all these perfect storm lining up?
Well, I think it's stock specific. I haven't gone down to the stock level yet. But then I think when the markets start to come off, what's going to happen is that investors, the institutional investors, the creditor ones, they'll look at they'll look at the counters that they have already made money, and they'll start to shave off the positions of those that have made money, right? That's intuitive. That's what's going to happen. So over-owned counters, if you're expecting the markets to come off, I think that there is a risk that it will again underperform, because the rest of them, like say the retail guys, the commercial guys, it will still go down. But then because it has already been thumbed down so hard, the percentage fall may be less than that of those over-owned counters.
All right, thank you very much. And Alice, coming back to you with regard to work from home, office space, is there still so much demand for office space, do you think, going forward? And will that impact these property stocks and S-REITs?
I think for the office market right now is in a way in a pause state, whereby tenants are reviewing how they can, do they really require so much office space going forward? So it is a huge transition, especially for the tenants. And as they grapple with the immediate cash flow issues with respect to their business challenges, tenants will likely hold back, to decide, how much space will they really need in the medium to long term. So it's a bit jittery for landlords, to be honest. But having said that, this is short term in my view in terms of the transition, because we are all dying to do business again. When the circuit breaker ends, when economic activity resumes around the world as well as in Singapore, and as we want to do business again, will virtual working, virtual meetings help to do business and close deals? I think that's the biggest question that all of us have. And perhaps the last 2 months has been important for us to maintain communications with our business partners in the course of us doing business. But will it lead to a transaction? Although there has been some successful cases, especially for private residential, where some agents did close deals, but the fact remains that face-to-face interactions and negotiations face-to-face is still pretty important to lead to a deal. I think that is something that could not change. And secondly, having that culture, that corporate culture, which the bosses of corporates, both MNCs as well as SMEs, are thinking hard how to continue to keep colleagues engaged. And 100% remote working, in my view, it is very difficult to continue to keep that corporate culture, because we human beings are still sociable, gregarious by nature. We still need that face-to-face interaction. So my view is that the office space will kind of recreate itself. The role will change, whereby maybe we will have less workstations because we can do our reports and analysis back home, But the office space will be newly created to be a space of meetings, discussions, interactions, and learning. So the next question will remain, will the space actually lead to a net decrease in demand? It all depends on how the companies restructure. But I would think in the short term, we might likely see some decline in demand for office space. Will landlords still be able to hold their rents? There's been a lot of debate about how much rentals might correct, but I think any correction or any reduction will likely to be short-lived, at best for this year, up to the end of this year.
Thank you very much. Due to time constraint, I'll just probably two more questions here, which I've taken up from the participants. Let's go to Geoff. Geoff, the departure of MSCI, how great an impact on SGX and how long?
Oh, okay. Well, we have had a very long and a very fruitful partnership with MSCI, and that will continue through the MSCI Singapore Index Futures that we discussed today. But, I guess over the years, we've built a very strong international offshore market for global investors with these single country products with MSCI. And of course, we still remain committed to providing our market participants with this platform for different country products. And look, it might have a near-term impact on our equity derivatives open interest, but at the same time, our multi-asset portfolio shelf of all these index futures, it has reached a critical mass. So, our track record in derivatives, our very good track record in derivatives does position us well to refresh and grow our Pan-Asian access products in a new direction. We will also be launching individual share futures very soon too on our big blue chip stocks. So we've got a lot in the pipeline in terms of the derivatives products, and we will still maintain this strong relationship with MSCI, but we've also, as I say, we've got critical mass now in our derivatives marketplace that we can explore new options that we're looking forward to.
Great, thank you very much. Last question from the participants that I'd like to just fish out from here. Just a yes or a no answer. Geoff and Terence, is it a good time to buy aviation stock now? Geoff, yes or no?
我不知道。
不知道。Terence.
Okay, I'll take it on, but I'll take on a more scientific approach. I've been very, very negative about SIA for the longest time. And it's like I think aviation in investments is just like bad overall. If you look at the ROEs, right? And particularly with the breaking of this crisis, I've done 7 webinars so far, and I've been negative on it. And it really puzzled me why, post-rights, there was a big jump in the numbers, then it started to fizzle. After this visiting of the of SIA shares, and if you look at the amount of money that's going to be poured back in, sure, this year is going to be a write-off, and the financial year end is in March. So FY21 is going to be really bad. We're talking about like over $1 billion worth of losses. So that's going to scare investors, right? But again, because they are able to get government support, the market have come in, they are able to what they call dong. They are able to tolerate, a lot of the backlash. So they have enough in their coffers to be able to withstand, I think, at least a couple of years. So, and currently, right now, and I think it's about 380, it is trading probably 0.6 to 0.7 times price to book. That's low by its historical standards. Typically, it trades anywhere between 0.9 and 1 times price to book. So in terms of valuation, it is not expensive. And if you believe that the government will stand behind SIA, as I do, and I think that it is one of those too big to fail, it would actually be able to survive through this crisis. Current levels, it is not expensive.
All right, not expensive. Thank you very much, Terence. I think that they've got the answer. So my last perspective here would be from each one of you guys. Yeah, we have got this participants. Almost 50% of them are newbies. 50% are seasoned investors. Now, if a participant has $10,000 spare cash at this moment, and another participant has $100,000 spare cash, what would you do if you have $10,000 spare cash only, or what would you do if you have $100,000 spare cash only? So, Uncle Song, start with you.
I think whether it's big or small, I still would split up into, say, 5 lots. I would say I wouldn't. As I believe I'm with Terence. I think this is a bumpy road ahead. We have got opportunities, as Geoff pointed out, in the markets with what's available for those who do not want to go abroad outside of Singapore to large market. If you want to stay in Singapore, by all means, there are lots of opportunity here, whether it's gold ETF or whether in terms of other derivative product or just straight equities or even bonds as well. But just split it up. This is a bumpy road. So I would just say buy on dips, trade if you are trader mentality, because it also depends on your age profile. You and I are older already, so we can be more risk averse. The younger one can take more aggressive, I suppose, position if they are traders, but just split them up and just don't be overcommitted at any point in time. And then I think you will sit through, because this is probably just the start of a fairly long haul. And Singapore Airlines, I think, is just will be an example. The fact that air corridor or bubbles or green corridors will be established between, say, Singapore and probably New Zealand, Australia, and maybe even China is start. And you will see probably SQ shares reacting to such news and development as well. But it is well below what things are going to be considered as normal. So you're not talking about normal trading. So trade with caution.
Trade with caution. Thank you very much, Uncle Song, and especially those our age range. Yeah, Geoff, your take. A quick one.
Yeah, if you've got 100,000, if you've got 10,000, I think you can still apply the basic framework of dollar cost averaging, i.e., spread it out. To add on to what Song said, you know, if you are unsure what the future beholds, go in a little bit at a time, you know, but fix the amount of dollars that you're going to spend, whether it's $1,000 every month, whether it's $1,000 every quarter, whether it's 10,000 a month, 10,000 a quarter. Spread it out, you know, because remember the advantage dollar cost average. If you've got an index at 3,000 and it drops to 2,000, if it drops to 2,000, the money you put in then will buy you 1/3 more units or shares. If it goes from 3,000 up to 4,000, you're going to be buying 1/3 less when it gets up to 4,000. So dollar cost averaging and applying a fixed dollar amount to your 10-year or your 3 years or whatever time frame you choose does seem to resonate well with investors who do have an element of uncertainty but do have to remain committed to their investing.
Thank you very much. Averaging. And Terence, your take.
I've been listening to what I have to say. I think that the markets are going to come off. Dollar cost averaging, yes, but possibly not yet. Because I think the onslaught is just next to us. It's going to be very close. I think the markets are going to come off, and I think that presents a good opportunity for some of these newbies to actually go plow in. As I said it quite a few times, never waste a crisis. And this crisis is as big as it gets. So we try to, we don't exactly try to time it, except that, given that, these circumstances are, there are going to be some negative factors. There's going to be a confluence of negative factors that's going to set in. I think it's going to be cheaper in not such a long period of time. So get ready your money, no hurry to point right now, but in the next few months as the markets start to come off, that may be a good time to look into good quality stocks, because when the bounce happens, it's going to be very significant.
Thank you very much. Alice, your take.
Right, my take is that I agree with Geoff. Dollar cost averaging is a good step right now, because as the market is hovering in a volatile fashion in terms of the equity side, and it's more accessible in terms of investment. So for those with 10,000 in cash, you can actually start to go into dollar cost averaging strategy into unit trust funds. I personally go into unit trust funds because I think it's safer and less volatile. I don't have to monitor the screen every day for the stock market's ups and downs. But it's important to look at what kind of unit trust you are buying. Study the fund carefully. Geoff, Terence will be great to advise them on what kind of funds to pick. But for those with 100,000 cash, right, actually you can really start to consider looking into property. In fact, I think it's a good time to look at property, because I believe in what Warren Buffett has always said, buy when others are fearful. And as the property market is now having a lot of options in terms of new sale and resale, and this pandemic goes to show that the home is truly where the heart is. The home is a place where you can do a lot of things at the same time. I think the space for home is limitless. In fact, you can do so many things at home. But of course, you still need to go out and interact and socialize, eventually. But the home is where you come back to, is your cave, and therefore you should use your 100,000. Take some time to look at the property that you like, depending on when physical viewings are allowed by the government. Try to do some research, look around virtually, call your agents. You can call analysts like me to ask about how the property market is trending. Take some time and at the same time invest in unit trust and a bit of equities, and when you have some upside, you gain some profits, and you can reevaluate again how you want to deploy your profit, either on equity or on property. It's always good to have a balanced asset allocation portfolio. Back to you, Boaz.
Thank you very much, Alice. And indeed, in this whole webinar today, it is, the future looks pessimistic. We need a lot of protection and wisdom and much prayer. Okay, so back to Howie, please.
Thank you. We're very glad to have our esteemed panel of guests this morning. And once again, thank you very much. And due to time constraint, we're not able to answer all the questions. But we've never been able to answer all the questions anyway. So if you have any future topics that you'd like us to discuss, drop us a message at events@theedgesingapore.com. And if you want to get the videos or some of the slides, you can scan the QR code on what you see on the screen now, or just go ahead with the link. Now with that, I wish everybody a great Saturday, and see you on the next one. Thank you once again. Thank you to our sponsor, Capital.